The era of €1 equal $1 has begun. As the US dollar continued to strengthen, the dollar became €1 for the first time in 20 years. A strong dollar is detrimental to US exporters. Concerns about an economic slowdown are spreading as the gap between long and short-term US Treasury yields widens even further. A reserve currency war between countries is in full swing. The Bank of Korea also took a big step to raise the benchmark interest rates by 0.5%. The era of the base rate of 0.25% has already passed. As the Central Bank of the United States has taken successive big steps or giant steps to keep up with inflation in its own country, other countries are forced to raise interest rates accordingly. In the past, whenever the value of the dollar, the key currency, fell, a currency war would occur in order to prevent a rise in the domestic exchange rate against the dollar and a decline in export competitiveness. The country tried to devalue its currency. However, deliberate manipulation of exchange rates under the floating exchange rate system is subject to strong sanctions from the international community, including the United States. Therefore, it was common to perform indirect market manipulation through interest rate cuts. But now, due to the unprecedented weakening of the dollar and the unprecedented interest rate hike by the US Central Bank, the country is competing to appreciate its currency. In other words, a reverse currency war is taking place. As the US continues to tighten its austerity measures and the unilateral strength of the US dollar continues, more than 60 countries, including Korea, are hastily raising interest rates to defend their currencies this month. Many major countries have already maintained their policy of raising the key interest rates by 0.5%. Raising interest rates and raising the value of the country's currency may weaken export competitiveness, but what is more urgent is to prevent a sudden outflow of funds. If the unprecedented strength of the dollar is left unattended, investors will all flock to the dollar. Import prices will rise and inflation will intensify. The so-called inflation export effect, in which the US interest rates hike stimulates inflation in other countries, is created. Individual investors investing in the foreign exchange market are also increasing. Stocks and Bitcoin, which were preferred by individuals, entered the bear market, and the strong dollar phenomenon is continuing due to the aggressive tightening of the US Federal Reserve. The trading volume of the euro-dollar market through the online investment platform eToro increased 72% month-on-month this month. Euro-dollars via eToro are markets in US dollars that are traded outside the US. eToro is a social-based trading and asset brokerage site. eToro is being serviced in more than 100 countries around the world, excluding the United States. Founded in Israel in 2007, it is currently registered in the UK, USA, Cyprus, and Australia. In eToro, you can trade a variety of assets, including stocks, currencies, and cryptocurrencies. As to gap between currencies other than the dollar, such as the dollar and the euro, which is showing strength alone in the market, continues to widen. The number of individuals trying to profit from the exchange has also increased sharply. Americans are also investing in foreign exchange. Americans enjoy shopping trips to Europe under the influence of the strong dollar. Furthermore, they are jumping into foreign exchange trading, the domain of Wall Street experts, and short-selling the euro. They primarily invest in exchange-traded products or options that can be traded on the stock market. Foreign exchange investment is highly volatile and therefore carries a high risk of investment. You should avoid investing simply because of alienation phobia. Some experts believe that it is already too late to take a profit on strong dollar betting. Since the euro has already depreciated a lot, it doesn't seem so good to take the trend called short euro now.